With great power comes greater responsibilities. While Narendra Modi and the BJP can bask in the glory of the mandate it's received from the voters, the new government has to hit the ground running. India's growth is showing signs of weakness and the markets are abuzz with concerns surrounding liquidity. So should the new government use its numbers and take some hard decisions early? And more importantly, what are the key indicators equity experts are waiting for? Let's ask some of those questions to a very special guest, Mr. Mark Mobius. He's joining us on the show right now. Mr. Mobius, thanks very much for taking out the time. Your reaction, obviously, you had earlier on in your previous conversations always suggested the possibility of a stable Modi government coming back into power. But now that is actually fructified, what is the big indicator and the big key issues that you think are going to be the most important in the first 100-day plan for the Modi government?
Well, the outcome has been really a big surprise because all of us didn't expect him to win by such a margin, and it's terrific news because it means that he now has the power to move ahead more aggressively than even his first term. So I think it's excellent news. Now he has to start looking at labor reform. The whole regulation of labor in India is out of whack with the requirements of the economy. We've got to get people employed, and we've got to get people employed on a massive scale. You've got 100 million people moving around India looking for jobs at any point in time. The farm sector is in trouble, and these people need work. They need to get off the farms and into work in the cities and in the urban areas. So I think that's a big challenge for Modi.
Do you think, though, the excitement around having a more stable government for the next 5 years is going to excite investors abroad who are looking at India from a fresh perspective now?
Well, it certainly excited me. As you know, I've been bullish on India for quite a while now, but this is really quite a nice change from my point of view. I wish I had more in India before this, but in any case, we have been investing, and we want to put more into India as a result of this.
Okay. Mr. Mobius, good morning. Neeraj here. The question mark in everybody's mind is that with the valuations that India is trading at, either there need to be some remedial measures on certain reforms that haven't yielded results thus far for the market to feel good, or earnings need to come back with a bit of a hurry. Since earnings are unpredictable, do you reckon that remedial measures or big ticket reform announcements within the first 100 days are a necessity?
I think so. I think they have to have not only announcements, but action taken to show that these reforms are going to be kicking in very soon. Of course, as you pointed out, earnings could move up, and that would mean the valuations, price-earnings ratios, would move down, and that would make the market more attractive. But what we're doing is looking at the medium-sized and smaller companies in India that may have not moved up as much as the big boys, and that's where we want to see opportunities. But as I said, these reforms have to kick in pretty soon for the optimism to maintain. I'm not saying that optimism will not be maintained for a longer term, but in the short term, we've got to see some real action on the part of the Modi government.
The other factor, Mr. Mobius, is a point that Morgan Stanley was making, that in any of the election years, dating back all the way to 2004, while the market may gyrate a lot in the election month, and they were looking at India as a reference point, in the next 6 months, the Indian markets usually tend to fall in line with the other emerging market performance. Do you reckon this time around could be the case too? And even if India were to take reforms and show earnings growth, if the larger EM or the Asia Pacific index slows down because of the trade wars or other issues, India will follow suit too?
That's a very, very good point you've made, because with so many ETFs, exchange traded funds, index funds, following the index, and the fact that you have China as a big factor in the index, about 30%, that drags down the index and therefore puts people off putting in emerging markets generally. Now, of course, there are a lot of people like us who say, look, I don't look at the index, and I'm going to be investing where I see the opportunity. And that means going to India. So it's a mixed picture, but I would say the point you've made is very well taken. A dragging down of the index is not good for emerging markets generally, and for India as well.
You know, while we're talking about some slowdown in China and you know, their macroeconomic data points not looking all that attractive, manufacturing is slowing down, but the big FII number for the month in China is quite a massive one. We've got negative inflows in most of the other emerging markets. India has got a negative inflow. You've got Indonesia losing out. You've got Philippines, Malaysia, everything else losing out in terms of the foreign money, which is going back into China. What turns that around?
What is happening in that case, in the case of portfolio investing, is the fact that China is getting bigger and bigger in the index. So a lot of the ETFs and index funds must put more money into China. That's one of the reasons why you see the flows. The other is that, of course, there are long-term investors from overseas that have been putting money into China to take advantage of this incredible consumer market in China, which is still growing. So you see that as a factor. The third is that the Chinese government wants to have more foreign exchange inflows in order to offset the problems with the trade. In other words, if trade goes down and they are not earning so much on trade, they want to have these foreign inflows to make sure that foreign exchange reserves stay up high and growing. So there are a number of factors at work which point out to what you're saying.
All right, you know, just coming back to the Indian markets, and I remember in your last interaction with us, you had said that you were pretty impressed with some of the managements of companies that you've met, and you said that you were impressed by their frugality and their cautious spending that they're undertaking. But if they're so cautious on spending, where will the growth come from? Where will the expansion come from? You have to prepare for the next leg of growth by making those kind of big ticket investments.
Well, one of the things that we see in India is there's lots of reserves. In other words, these companies often have very strong balance sheets, so they do have the resources to expand. And if they are optimistic and they believe that Modi is going to make changes that benefit their businesses, they're going to be investing. There's no question about that. The other good news of this situation is that investors looking at these companies and seeing the strong balance sheets will be willing to put more money in. And that will be positive in terms of capital raising. So there's another final factor, I think, which is very important, and that is the consumer spending in India is moving up, and the access to information about products, services, etc., is expanding as the number of people with smartphones increases dramatically in India. So all of these factors, I think, are very, very important, giving confidence to the capital markets.
So if that's going to be the next big change that's happening at the ground level, would you say that telecom providers, IT services companies are the ones that are going to benefit the most?
They will benefit. Of course, they will be the purveyors of growth in a sense. I mean, the incredible work that Reliance has been doing in laying fiber all over India, making communications cheaper and cheaper. They have benefited the general economy as a result of the acceleration in communication. Now we have to do more on infrastructure, roads, railroads, airports. Of course, a lot have been done already, but more has to be done in the aircraft area. And, airlines have to be improved in India to take care of this incredible growth. So that's where the challenge will be going forward.
Dr. Mobius, the other big question in the minds of almost all investors is what happens to India if indeed the financial sector issues don't get resolved, because almost everything is getting pump primed via financing. We talk about the great compounding consumption machine in India, which in part is happening because of the easy liquidity in the NBFC space that was there. Now, would you expect reforms or liquidity injection in that area very, very soon? And part two of my question, Mr. Mobius, would be what do you expect the Reserve Bank to do in a meeting that comes up in less than 15 days from now?
Of course, nobody knows what the Reserve Bank is going to do from one day to the next, but I get the feeling that they probably will be very cautious in raising rates, that's for sure, and they may even lower rates. Yes, there's some talk about inflation in India moving up, but I don't think that's very significant. And if the Modi reforms kick in, then you'll see inflation actually coming down because the economy will be much more efficient, and you're going to see much better situations in terms of capital raising. I think the first part of your question is very important because with confidence comes credit, with credit comes money. And I believe that more and more people will be willing to finance companies, buy bonds, because of the confidence that we see as a result of the Modi win. So a lot of the problems the banks have had in the recent past will be solved. They've already been to some degree solved as a result of help by the government. But now you'll be able to see private money coming in and moving up some of these companies and strengthening their balance sheets and strengthening the banks' balance sheets.
Mr. Mobius, you've looked at emerging markets and India for a really long time now. As your team scouts around India for newer investment opportunities, if you find valuations to be compelling, would you reckon, because you're such a veteran of so many cycles, would you believe that it might be comfortable to go out and park large money, put large money to work in India in specific pockets, even if there are two risks, one that earnings for the broader markets don't pick up, or the other risk being that the emerging market, the Asia Pacific markets don't perform as well because of the global factors that we discussed earlier?
Well, I would prefer to put more money into India and even have a weighting in India that's larger than China, simply because of the growth prospects and the incredible opportunities that we see. Now, of course, this depends on many, many factors. Liquidity, when you look at some of the companies in India, the liquidity is not as good as you'd like, and other factors. But I would say, generally speaking, we'd like to put more money into India.
Let's talk a little bit more about which are those pockets. I mean, you have two funds running in India. You've identified the areas of growth. You've identified good companies which have good return on capital, because that's, in your last conversation, that's something that you had already highlighted, that you're looking for companies with a good return on capital. Where are these pockets of growth coming from? Where are these opportunities coming from?
What we found that there are many industrial companies, manufacturers in India that have excess capacity, that can expand their markets, that are going global, by the way. Many of them are, in terms of technology, doing a very, very good job. And we're particularly interested in those companies that can supply the infrastructure market, because we believe that infrastructure spending is going to be increasing. Already it's increasing, and Modi will be doing more in that space. So anything that would supply this growth is going to be very important. For example, companies that produce pipes would be probably a very good area to invest. Steel, reinforcing bars, all of this kind of activity will be something that we will look at. So that would be one area. The other area would be, oddly enough, the non-banking financial area. Many people have been down on that sector, and of course some companies have had problems. But I believe with the expansion of the individual in terms of banking, with the identity card system kicking in and people opening bank accounts and being more familiar with the banking sector, being able to access credit, that will be a big, big growth area, and we want to be exposed to that. So I would say those two areas are particularly important. And then if you look at the consumer area, generally speaking, anything involving consumer spending will be something we want to look at. Unfortunately, many of these stocks are rather expensive, but we are continuing to look.
Mr. Mobius, one final question from mine at least. A lot of us are trying to draw parallels as far as the investing opportunities go between what happened in 2014, or key learnings that came out from the first regime of the Modi government versus the second regime of the Modi government. And I remember, and you would remember too, that when the first regime came about, the expectations were sky high. There were a lot of expectations about cleaning up the public sector units in India, railways, defense, so on and so forth. And all of those turned out to be very tedious or unrewarding investment opportunities. Would you reckon that in the second regime, investors should be a bit more smart and not bet on hope trades and purely focus on earnings?
Well, as you know, whenever you have a euphoria, it's going to be followed by some depression to some degree. I hate to say the words "this time is different" because those are probably the most expensive words in the world. But there is a difference now because things have accelerated because of the communications revolution. And the fact that Modi has gotten a stronger mandate than the first time around means that there is an opportunity for us to move further ahead. So I get the feeling that we're going to see much better changes and faster changes than the first time around. This may be over-optimistic, but I think it's a fair statement to make.
Just one last question now before we wind up, Mr. Mobius. Taking a look at the performance of the Indian equity markets right up from the previous election when the Modi wave kicked in, the indices have gone up just about 64% So probably would have anticipated slightly more from the benchmark indices is what we've seen from the broader market space. But do you think that returns and the excitement around this time could lead to slightly more amplified returns, considering that kitchen sinking across various sectors is sort of already done? And this foundation has been laid, and the next leg is going to be a big one.
I think the next leg will be a big one and will surpass the previous high last year, at least just looking at the MSCI index. We still have to pass that high, and I think it will be done. Of course, you know, you're going to get corrections along the way, but the general trend is up, and I expect that previous high to be surpassed.
Oh, interesting. Mr. Mobius, thank you so much for taking the time out and speaking to us at Bloomberg Quint India. Really appreciate your time.
Thank you.
Viewers, thanks for tuning in to this broadcast.